Imagine waking up one day with complete financial freedom, the ability to travel, retire early, or pursue your passions without worrying about money. Sounds incredible, right? But here's the thing. Most people never achieve this because they don't know how to make their money work for them. If you've ever felt overwhelmed by investing but confused by stock charts, real estate jargon, or the endless financial advice online, you're not alone. The truth is, building wealth doesn't require a finance degree or a six-figure salary. It's about having the right strategy, discipline, and long-term mindset. But today I'm going to give you something different. I'm going to walk you through the ultimate guide to investing for beginners. By the end of this video, and before we dive in, let me be clear. I'm not here to sell you anything. This isn't about gimmicks or shortcuts. It's about building wealth the right way step by step, with consistency and discipline. So, if you're ready to take control of your financial future, hit that like button, subscribe to the channel, and let's get started. Step 1. Understand why you're investing. The first question you need to ask yourself isn't how to invest, it's why you're investing. Are you saving for retirement, trying to build wealth over time, or maybe you want to buy a house in 5 years? Your goal will determine how you invest. For example, if you're saving for something short-term, like a vacation next year, you don't want to put your money in risky investments like stocks. Instead, safer options like high-yield savings accounts or CDs make more sense. On the other hand, if you're playing the long game, for retirement, let's say, you can afford to take more risks because you have time to recover from market dips. Now, let's talk about inflation. Inflation is the silent thief that eats away at your savings. Let's say you save $10,000 today. If inflation averages 3% per year in 10 years, that $10,000 will only have the purchasing power of about $7,400. That's why investing is crucial. It helps your money grow faster than inflation can erode it. So here's the takeaway. Know your goal, understand your timeline, and choose investments that align with both. Step 2, start small and build consistency. One of the biggest myths about investing is that you need thousands of dollars to get started. That's simply not true. In fact, one of the best ways to start is small, really small. Even $50 or $100 can be enough to open an account with apps like Robinhood, Acorns, or Webull. Here's the secret sauce. Consistency beats lump sums. Instead of waiting until you have enough money, commit to investing a little bit regularly, say $20 or $50 per month. This approach is called dollar cost averaging, and it helps you avoid emotional decisions based on market swings. Plus, watching your portfolio grow over time, even if it starts small, is incredibly motivating. Let me share a personal story. When I first started investing, I didn't have much money, but I committed to putting aside $50 every month. Over time, those small contributions added up, and the power of compound interest did the rest. By the time I was in my late 20s, I had built a solid foundation that allowed me to scale my investments even further. So, don't wait around for the perfect moment. Start today, even if it's just $20. The key is to get started. Step 3, learn the basics of investing. Now let's talk about what you can actually invest in. These are called asset classes, and they come in different flavors depending on your risk tolerance and goals. Here's a quick rundown. First, stocks. When you buy a stock, you're buying a tiny piece of a company. Stocks tend to offer higher returns, but come with more risk. For example, companies like Tesla, Apple, or Amazon can provide substantial gains, but their prices can also drop sharply during downturns. Second, bonds. It's basically loans you give to companies or governments, and in return, they pay you interest over time. They are considered safer and more stable than stocks, making them ideal for conservative investors seeking steady income. Third, real estate. It involves owning physical properties or investing in REITs that allow you to earn rental income or benefit from property value appreciation. It provides steady cash flow and long-term growth potential, making it a favorite among investors seeking tangible assets. However, real estate requires upfront capital and ongoing management, which can be a barrier for beginners. Fourth, Cryptocurrency, Bitcoin and Ethereum are digital assets known for their extreme price volatility, offering the potential for massive gains, but also significant losses. As a beginner, I recommend starting with index funds, or ETFs, exchange-traded funds. These let you own a slice of the entire stock market instead of betting on individual companies. For example, an S&P 500 index fund gives you exposure to the top 500 companies in America. Simple, diversified, and low cost. Now, let's break down why index funds are so powerful. Imagine you invest $1,000 in an S&P 500 index fund. Historically, the S&P 500 has returned about 7 to 10% annually. Over 30 years, that $1,000 could grow to over $7,600 without you lifting a finger. That's the magic of compound interest. But here's the catch. You need patience. The stock market doesn't go up in a straight line. There will be ups and downs, but history shows that over the long term, it always trends upward. So, stay consistent and don't panic during downturns. Step 4, open the right account. Once you know what you want to invest in, the next step is choosing the right type of account. There are two main types you should consider as a beginner: taxable brokerage accounts. These are flexible, you can withdraw your money anytime, but you'll pay taxes on your gains. Retirement accounts, like individual retirement account or 401k. These come with tax advantages, but usually lock your money away until retirement age. If you're young and just starting out, I suggest opening a Roth IRA. You contribute after-tax dollars, but your withdrawals in retirement are completely tax-free. It's like planting seeds now that grow into a lush garden later. Another option is a 401k, especially if your employer offers a match. For example, if your employer matches 50% of your contributions up to 6% of your salary, that's free money. Never leave free money on the table. Finally, if you're looking for flexibility, a taxable brokerage account is a great choice. Platforms like Vanguard, Fidelity, and Robinhood make it easy to start investing with minimal fees. Step 5, avoid common mistakes. Before we wrap up, let me warn you about some rookie mistakes that trip up even smart investors. Trying to time the market. No one knows when the market will go up or down, not even Wall Street pros. Focus on consistent contributions instead. Panic selling. Markets crash sometimes, but history shows they always recover. Stay calm and stick to your plan. Overcomplicating things. Don't try to pick the next big stock or jump into crypto without understanding it. Keep it simple. Remember, investing is a marathon, not a sprint. Slow and steady wins the race. Step 6. Scale your investments over time. As your income grows, so should your investments. One of the biggest mistakes people make is failing to increase their contributions as they earn more. Let's say you start by investing $200 a month. That's great. But as your salary increases, bump that number up. If you get a raise, allocate a portion of it toward your investments. This is where automation comes in handy. Set up automatic transfers from your checking account to your investment account. That way, you never miss a contribution, and you're consistently growing your wealth. Over time, you'll reach a point where your investments are generating significant passive income. Maybe it's dividends from stocks, rental income from real estate, or profits from a side hustle. At that point, you're no longer trading time for money. You're building true financial freedom. By now, you have everything you need to start investing with confidence. Remember, building wealth isn't about chasing the latest trends or trying to get rich overnight. It's about consistency, patience, and making smart financial decisions. Start small, stay disciplined, and let time work in your favor. If you found this video helpful, make sure to smash that like button and subscribe for more game-changing financial content.